Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. We're excited to get started today to discuss, I have $1 million in my solo 401k. Should I convert to Roth to avoid RMDs, required minimum distribution? Great, and we're also on Instagram now. Again, here to discuss, I have $1 million in my solo 401k. Should I convert to Roth to avoid RMDs? As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor is it solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So a common question we hear is, I've got a significant amount in my solo 401k. Should I convert my pre-tax solo 401k to a Roth? Well, it's a very important question. It's a good question, especially if you are sitting on a large account balance, like $1 million in our scenario that we presented at the top. So today we want to go over some of the mechanics, some of the considerations that you'll want to consider in consultation with your tax and legal advisors. So for example, we'll discuss how a Roth conversion would work and ultimately would allow you to have the potential for tax-free growth, how you can avoid required minimum distribution so you can ditch those RMDs, say goodbye to those mandatory withdrawals. We'll talk about some of the strategies that some use to make the conversion work for your unique situation. So let's start out with the basics, introduction to Roth conversions. So our solo 401k plan allows, of course, for pre-tax funds. So these could be pre-tax contributions that someone makes to their solo 401k. A solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because the plan allows for both employee and employer contributions. So both of those contributions could be made as pre-tax contributions. Another way that someone will end up with pre-tax money in their solo 401k is if they rolled money over from, say, a former employer plan or a non-Roth IRA, and then, of course, just growth within that solo 401k, right? Our plan allows for not only brokerage type investments like stocks, bonds, mutual funds, but also alternative investments such as real estate, private placement, crypto, etc. So sometimes you'll have someone that has a large account balance in their pre-tax solo 401k. So our plan would allow them to do an in-plan conversion, or some refer to it as an in-plan rollover, where the funds are moved from the pre-tax account over to the Roth account, or it could be an in-kind in-plan conversion. So one is moving assets that are in their pre-tax solo 401k over to this Roth solo 401k sub-account. So the funds, the cash, they're staying inside the plan, but they're moving from a pre-tax status to a Roth status. So that means you're going to have to pay taxes on the value of the assets or the cash that's converted from the pre-tax solo 401k account to the Roth solo 401k account. So you pay taxes now, but you have that potential for tax-free growth and withdrawals later, because like any Roth account, the gains, the subsequent growth in that account is going to be tax deferred, potentially tax-free. It'll be tax-free if at the time of the withdrawal from the Roth Solo 401k, you've had the account for at least 5 years and you're at least 59 and a half years of age. Now, thanks to Secure Act 2.0, RMDs were eliminated with respect to Roth 401k accounts. So Roth 401ks starting in 2024 no longer have RMDs. So what's an RMD? An RMD is a required minimum distribution. So once you reach a certain age, the rules are going to require that you withdraw money from your pre-tax solo 401k, right? So the thinking is that essentially when you put money into the pre-tax solo 401k, you are doing that on a pre-tax basis, right? So you earn money in your business, for example, with a contribution, but instead of having to pay taxes on that income when you earn it, if you have a solo 401k plan, if you're eligible to set up a solo 401k plan because you're self-employed with no employees, you can make a pre-tax contribution to reduce your taxable income now for the year for which you make the contribution. But ultimately, the government's going to want to tax that income. So when you withdraw it from the pre-tax solo 401k, you'll have to pay tax at that time for the year of the withdrawal. So the required minimum distribution rules come into play to say, okay, well, once you reach a certain age, we're going to require that you start to take money out of the solo 401k to draw it down. But now, thanks to the Secure Act 2.0, if you move the money from the pre-tax status to the Roth status, you won't have to take required minimum distributions from that Roth 401k. So you'll have to pay taxes when you move it into the Roth Solo 401k at the time of the conversion, during the year of the conversion. But all the subsequent gains will be tax deferred and potentially tax free if at the time that you take it out, you've had the account for at least 5 years, the Roth account, and you're at least 59 and a half years of age. Or if you don't want to withdraw it from the Roth 401k, you don't have to. Because again, there's no required minimum distribution that applies to a Roth 401k starting in 2024. So why consider a Roth conversion, right? What are the advantages of moving from a pre-tax status to a Roth status? Well, we just touched on one, right? There's no RMDs when you reach age 73 with respect to that Roth Solo 401k, thanks to Secure Act 2.0. So your money grows tax-free, tax-deferred, potentially tax-free. If at the time of the withdrawal, you've had that Roth Solo 401k account for at least 5 years and you're age 59 and a half. So that ultimately is going to give the individual more control over their taxable income. Because if you're forced to take money out of the pre-tax solo 401k, then you're forced to pay taxes at that time, at least with respect to the required minimum distribution amount. But if you move it from a pre-tax status, if you move those pre-tax funds to a Roth Solo 401k, you can control how much you move. Therefore, you can control how much income you're going to have to report as taxable income, because the amount that you move is going to be taxable for the year of the move. So now you take control over when you'll pay tax on that income. And the theory is that you'll pay taxes now at potentially lower rates. So it's a hedge against future taxes. There are, of course, important considerations and potential downsides, right? One, of course, is obvious. You're going to have to pay taxes on the amount that's moved for the year of the conversion. So the converted amount is added to your income and taxed in the conversion year. You're going to have to pay taxes from outside funds. Ideally, you would use non-retirement money to pay the conversion taxes, just from the perspective of preserving your retirement account balance. The conversion's permanent. You cannot undo a Roth conversion. And the money is going to have to be within that Roth Solo 401k account, or you'll have to at least have that account for 5 years and wait till you're at least age 59 and a half if you want to withdraw it totally tax-free. So there may be some waiting period involved, in other words. So those are definitely important considerations. For some, they may view that as a potential downside. So it's important to understand the implications of doing a pre-tax to Roth conversion. So that then leads into, okay, well, when is a Roth conversion potentially not right? When a Roth conversion might not be the right thing to do? Well, if you expect a lower future tax bracket, right, the thinking is that if you think your tax rate is going to be lower in retirement, then ultimately it may be better to just leave it in the pre-tax account, because at that time you'll be paying at a lower tax rate. If you intend to transfer funds, right, if you retire and you shut down the solo 401k and you intend to transfer those pre-tax solo 401k funds to a pre-tax IRA and then take a qualified charitable distribution, right, where you contribute those pre-tax IRA funds to a charity, that's going to avoid taxes, right? That's the benefit of making a qualified charitable distribution. So that would be a reason to keep the money in a pre-tax status, right? Because if you move it inside the plan from a pre-tax status to a Roth status, right? Then you want to eventually move it over to a Roth IRA and then make a qualified charitable distribution. Well, there really is no tax benefit at that point of making that qualified charitable distribution. Obviously, there still could be a benefit of donating to a charity, right? The charity of your choice. But in terms of the tax benefit, you're giving it up because there's really no benefit from a tax perspective of making a qualified charitable distribution from a Roth IRA account. If you think that you might need the solo 401k for current income, right? Because remember, we talked about the whole 5-year rule, et cetera, et cetera. So if you're relying on these funds for daily expenses, that might be a consideration that would give one pause before they're proceeding with the in-plan pre-tax to Roth conversion. Before we talk about strategic approaches, we just want to stop. If you could please like this video or share it with those who might find it to be helpful, that would be very much appreciated, just to help us get the word out to other self-employed individuals, other solopreneurs, other freelancers, just like you, that might find it to be helpful, right, as they're trying to secure their retirement, grow their retirement account balances, etc. Also, if you subscribe to our channels, whether on YouTube or LinkedIn or Instagram or X, you'll get notifications of when we go live, right? We go live twice per day, once at 10 a.m. Pacific, 1 p.m. Eastern. We come back again in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern. We typically have prepared content like we do today, but we also are always open for a Q&A session. So if there's any questions on this topic or other topics, please don't hesitate to ask, because we're happy to discuss either on-topic or off-topic questions. So now let's get back to strategic approaches to converting, right, from a pre-tax status to a Roth status to avoid required minimum distributions. So just generally, when it comes to some of the approaches that we see based on experience and client feedback, would be laddering or partial conversions. In other words, convert smaller amounts over several years to manage taxes. Timing is key, right? A lot of individuals want to convert during low income years or gap years, for example, between retirement and Social Security, market downturns, right? Because we talked about earlier how you can convert in-kind assets, right? You might have a particular stock investment inside your pre-tax solo 401k brokerage account. So if that account value is temporarily lower, you pay the income taxes based on the value at the time of the conversion. So if the value's down, you pay less taxes because it's technically less income. Ultimately, whether a Roth conversion is right for you is, of course, a personalized decision that'll depend on your unique financial situation and goals. You want to consider the topics that we discussed, as well as just current and future income, tax brackets, liquidity, time horizon, et cetera, and always, of course, in consultation with professional advice, right? We highly recommend to consult a financial advisor and tax professional to help you just analyze your specific situation. So with that, we always like to highlight that we have a community. We have over 30,000 members. It's totally free to join. All are welcome. We have forums. We have a library of videos and webinars. We have the industry's first AI, which is totally free to use. You're welcome to use it at solo401k.ai. It's a great way to find resources and answer questions quickly. We'll give it a moment to see if any questions come in, but we do appreciate the chance to discuss these topics. Thank you so much. Again, if you could share with others who might find it to be helpful, that'd be fantastic to help us get the word out. And with that, we'll be back. As always, we'll continue with our daily seminar. So please subscribe so you get those notifications. And we again appreciate the engagement and the chance to discuss. Until next time.